What happens if investors, savers, markets around the world lose confidence in the US dollar? And by the way, if people lose confidence in the US dollar, don't think for a minute that they're going to run to the euro, the yen, pound sterling, Canadian dollars, or whatever. They're not. All those currencies are part of a global euro dollar, US dollar system. So if you lose confidence in US government securities, for example, the US dollar, you're not going to run to, German bonds or Japanese government bonds. That whole system is going to be severely impaired. In which case, you may have to go back to some kind of gold standard, gold linked, gold backed in some fashion, not because you want to. There's no central bank in the world that wants to go to gold, but they may have to restore confidence. Now, if you do, if you say, okay, we have to get back to some kind of gold system to restore confidence, what would the price of gold have to be to make that system work? Well, we have a lot of historical precedent. There was a real gold standard, solid gold standard from 1870 to 1914, modified gold standard after World War I, say 1919 through World War II, the Bretton Woods standard from 1944 to 1971. So we do have precedent for this. In every case, you don't have to have enough gold to back 100% of the money supply. Some of the hard shell gold bugs say you do, but that's not true. Historically, you need between 20 and 40%. So let's just take 40%. Look at the U.S. money supply, and I use M1 because it's broader than Fed-based money. It includes checking accounts. It's kind of like money from the banks that drives the real economy. So if you take M1 and take 40% of that and say, okay, that's how much gold I need to back it up, and then say, okay, how much gold do I have? The answer is 8,133 tons. That's how much gold the U.S. has. And just do the math. As I say, this is seventh grade math. What would the price per ounce have to be for 8,000 tons to back up M1? And the answer is $27,000. By the way, I did the same math 7 or 8 years ago, and the answer was closer to $15,000. But the reason it's higher, gold is still gold, but the money supply is a lot bigger. So with the same amount of gold and a larger money supply, you need a higher price per ounce to back up the money supply. And by the way, I spoke to Paul Volcker about this, and he agreed. He said he wasn't advocating for a gold standard, but he said if you had to go back to a gold standard, he just threw his hand in the air and said, oh, the price of gold would be unbelievable. And of course, he's right. So if things kind of remain the way they are and confidence in the dollar remains, we can talk about that, by the way, because there are arrows directed right at the heart of confidence in the dollar having to do with Russian assets in the war in Ukraine. If confidence is maintained, then it's a market factor. Maybe you don't get there. But if you have to go back to a gold standard, $27,000 would have to be the price in order to avoid massive deflation. More likely all the time because of the stupidity or blindness of administration officials. And here, let's talk about the effort to steal Russian assets. Now, at the start of that, the U.S. froze the assets of the Central Bank of Russia. Yes. Almost unprecedented, not completely, but almost. About $300 billion of U.S. Treasury securities owned by Russia. They had surpluses, they had dollars, they invested the dollars in U.S. Treasuries. They had about $300 billion. They're all digital book entry. There's no physical Treasury securities you can put in a vault. Haven't been since 1979. So this is a digital ledger maintained by the Federal Reserve and the U.S. Treasury. And Russia had about $300 billion of Treasury securities. So we froze them. Freezing them just means, okay, they're still Russia's securities, but they can't use them. They can't collect the interest. They can't pledge them. They can't repo them. They can't sell them, etc. They're kind of frozen, but they still belong to Russia. Now the U.S. wants to go a step further and seize them, actually convert the title, turn it over to some trust fund for the benefit of Ukraine. And actually, they say seize, I say steal. So they want to steal the Russian assets, $300 billion. Now, we have a G7 summit coming up in about 2 weeks in Italy. They've been working on this for over 6 months. At the G7 meeting, they want to formalize what they're going to do. Now, there's several different proposals. One is just to seize the whole $300 billion. One is to issue a $50 billion bond issue backed by the Russian assets. So, of course, Ukraine would default on the bonds and the creditors would seize the assets. It's just a backdoor way of stealing the assets. Some people say, well, they'll just steal the interest. It's about $3 billion a year, so there's about $6 billion of interest piled up. So there are different things in play. We'll see what they actually do at the G7 meeting, but they're all the same in the sense that they involve stealing these Russian assets. Now, it doesn't mean that the next day the U.S. Treasury market collapses. There are, forecasts like that. Some people get a little hyperbolic. It doesn't mean that. I mean, the Treasury, one phone call to Jamie Dimon at JP Morgan and tell them to buy US Treasury notes, and they will. The banks will do what they're told. But here's where the system could collapse. First of all, Putin would retaliate. There are well over $300 billion of Western assets in Russia. BP, Chevron, Shell, major U.S. oil companies, Starbucks, Coca-Cola, McDonald's, you name it. A lot of those businesses have kind of pretended to get out of Russia, but the assets are still there. Franchises are still there. Russia has not expropriated them, but they could. They could take all this, and they will. Putin said, the thing about Putin is he doesn't bluff. He thinks very carefully about what he says. When he says something, he'll do it, and he has. So if the U.S. steals the Russian treasuries, Putin will expropriate Western oil and energy and natural gas assets and just give it to Rosneft or Gazprom, which are the major Russian energy companies. It's estimated that there are more Western assets in Russia than there are Russian treasury bonds in the West. So Putin could actually make a profit on this whole thing. But here's the other play that, is clear to me because I'm a lawyer, but no one else has even discussed. Where are these assets? There's only about 5 billion of the 300 in U.S. banks, and those can be stolen very easily. But over 200 billion are in Euroclear. Euroclear is the largest clearing, settlement, and custody organization in Europe, and it has over $40 trillion of total assets, stocks, bonds, other types of securities, etc. But it has these 200 billion of the 300 billion Russian assets, U.S. Treasury securities, are in Euroclear. Now, if you seize those, Euroclear has offices around the world. They have offices in Bahrain, UAE, Hong Kong, Singapore, rep office in Beijing, etc. Russia could sue Euroclear in any one of those offices. And just take Hong Kong, for example. Hong Kong is an interesting case. It's under the thumb of the Communist Chinese, but it kind of walks and talks like a Western legal system, and they have lawyers and courts and all that. So Russian lawyers show up in Hong Kong, sue Euroclear for 300 billion or more, with damages, etc., and get a judgment in favor of Russia. Russia can now run around the world and seize Euroclear assets that belong to anybody to recover that judgment. You could throw a monkey wrench into the entire global clearance and settlement system by disrupting Euroclear, which is probably second only to DTCC in terms of settlement and clearance. So this is an example of the stupidity of U.S. officials. Janet Yellen doesn't understand any of this. Her deputy, Wally Adeyemo, doesn't understand it. But the real danger is not that the treasury market collapses the next day. That could happen over time. It's that Russia retaliates, gets a judgment, and freezes the entire Western clearance and settlement system. I cannot think of an example going back years where the U.S. has been able to think 2 moves ahead. They're just not that bright. I mean, I met with senior Treasury officials. I've been at the Fed, the White House. I've sat at the Pentagon with one person away from the senior Treasury official with responsibility for the dollar relations in Asia. And I told them exactly what I just told you. I mean, in different scenarios, they don't get it. They bang the table. The U.S.'s dollar is the reserve currency. It always will be, etc. They're really blind to this. So I wouldn't count on them being able to see through it. But coming back to your other point, yeah, it's a big deal. Now, there's the reality and then there's the story. So what's the storyline from, the deep state and the mainstream media and all that? They're saying Trump wants to start the currency wars and he wants to weaken the dollar, to promote U.S. exports and export-related jobs, etc. That's the kind of we're supposed to worry because Trump's going to destroy the dollar. First of all, it's not true. That's not what he's doing. Trump is not trying to start or continue a currency war. He's trying to end the currency war. The currency war has been going on since 2010. That's what my first book was about. But I also said in that book came out in 2011, I said currency wars, we're not always in one, but when we are, they can last 15 or 20 years. So here we are, 2024. I'm not surprised that, 13 years after the book came out, we're still in a currency war because I said that's how long they can last. And we are. So it's not a new currency war. It's been the same one that's been going on for, 13 years. But what Trump's trying to do is end it. His model is what Ronald Reagan and James Baker did at the Plaza Accord in 1985 and the Louvre Accord in 1987. So what was going on then? Coming out of the severe recession of 81, 82, 20% interest rates, Paul Volcker, etc., we finally got inflation down to about a little over 3% by 1983. Growth was really strong, 16% compound growth between 83 and 86. The dollar hit an all-time high. If you look at the Fed Broad Trade Weighted Index, the dollar hit an all-time high in 1985. Baker and Reagan, Baker was Secretary of the Treasury at the time, decided the dollar was too strong. And they didn't want to trash it. What they wanted to do is get together with Japan, Germany, because remember, this is before the euro. So you still had the Deutschmark and the French franc and sterling and yen and all that. They met at the Plaza Hotel in New York. They had a conference with the finance ministers, and they agreed on new parities. And they said they were going to intervene in markets to cheapen the dollar, but it was a controlled cheapening. It was by agreement. It was by consent. And they did it. And then by 1987, the dollar had got weak enough that they said, okay, that's good. Let's lock it in. And they met at the Louvre in Paris. They set the new parities. They agreed to keep it there. And for almost 20 years, from 1987 to 2010, I guess a little over 20 years, that was the great moderation. We didn't have high inflation. We didn't have currency wars. The price of gold didn't do a lot until after 2000 for other reasons, but you did have great currency stability. And that kind of blew up in 2010 after the global financial crisis. We're not going to trash the dollar or destroy the dollar. He wants to have another sit down with the G7 members, and in theory it would include aided by China and Russia or other large economic powers, and set new parities and move towards them. And it might involve a slightly cheaper dollar, but it wouldn't be an outright war. It would be moving towards currency stability. Now, here's the twist. You're invited to this meeting and you can work with the United States to achieve these parities. But if you don't, if you're using excess capacity and you're dumping and you're trashing your own currency, then we're going to hit you with tariffs. So your choice is going to be join this currency club, which modeled on the Plaza Accord, or we're going to slam you hard with tariffs, which Lighthizer did to the Japanese. That's how he saved the U.S. auto industry in the 1980s. Japanese were taking over. They put high tariffs on Japanese cars. So this is not a currency war. He's trying to end a currency war. He's trying to achieve stability and do it cooperatively. But if you don't join the club, you're going to get hit with tariffs. So yes, you can see that coming. Say, who are the winners in that? The winners are people who invest in the United States and workers. The losers are people who are, betting on China or, getting their money out of the United States. The BRICS, as they are today, so that includes 4 new members who joined the summit in South Africa last year. So now we're up to the BRICS 9, I guess, BRICS Plus, call it. They represent over 50% of the world population. If you use purchasing power parity, about 55% of global GDP. 2 of the 3 largest nuclear arsenals. 3 of the 5 largest oil producers. This is not your grandfather's third world. These are not poor, impoverished third world countries. These are political superpowers, military superpowers, and economic superpowers. So first of all, it's not a tribute group, number one. Number two, if you're asking, will the Russian ruble be a global reserve currency? No. Will the Chinese yuan be a global reserve currency? No. I could give you 100 reasons why, but they don't have bond markets. They don't have good rule of law. They don't have repo, primary dealers, et cetera. They don't have all the things you need in terms of having a securities market to be a global reserve currency. So you can forget about that. But could they collectively issue a new currency? Call it a BRIC, call it whatever you want. They call it a bank order that they would all accept and trade between each other, and that actually third parties would be welcome to join. An issuing bank and a clearing mechanism and evaluation mechanism. Yes, that would not be that difficult to do. In fact, they're already working on it. So why haven't they done it yet? What's the missing ingredient? Well, here's the missing ingredient. So right now, Russia and India, the 2 of the BRICS members, they're trading with each other. And Russia's shipping, oil and natural gas to India. And India doesn't want to pay in dollars. There's difficulty paying in dollars. They can pay in rupees, which doesn't have to go through SWIFT. Mm-hmm. But the question is, how many rupees does Russia actually need? The answer is not many. And what can you do with them? The answer is not much. And for that matter, same is true in China. What are you going to do with all the Chinese yuan? You buy some Chinese stuff, but there are limits on that. So the problem with bilateral local currency settlement is if you're the seller and you get the local currency, what are you going to do with it? And the answer is not very much. And none of those currencies are big enough to support reserve currency status. But if you get 10 or 15 or 20 or more countries in the BRICS, now you've basically duplicated the euro, the European monetary zone, because you can go shopping in 20 different places. So now in this world, I'm Russia, I sell oil to India, they pay me in the BRICS currency, but I don't have to spend it in India. I can go to Brazil and buy aircraft. I can go to China and buy semiconductors. I can go to Iran and buy drones, etc. So the key ingredient is not the currency concept, it's the size of the area. And that's what they're working on. And the next BRICS summit is in October in Russia, because they have a rotating chairmanship. So this year, Russia's the chairman. Sergei Lavrov, the foreign minister, has been a thought leader in this. Viola Nabulina, the head of the Central Bank of Russia, is brilliant. So they are moving in this direction. I can't account for what our Bitcoin friend said, but he apparently doesn't really understand what the BRICS are doing. The gold powers, the biggest gold powers in the world, if you take gold as a percentage of GDP, so GDP is your economy, and gold is, I think of it as real money. So take that gold to GDP ratio. The two biggest powers in the world are Russia and Switzerland. They have ratios of kind of between 9 and 12% gold to GDP. US is pretty weak, about 2%. China is a fraction of 1%. So they don't have anywhere near enough gold. Why are they buying gold? The answer is twofold. Number one, this new BRICS currency may have a gold linkage. Now, I'm not saying it's going to be gold back. You're not going to be able to take your BRICS currency, march down to the People's Bank of China and say, give me some gold. They're not going to do that. But it will have a linkage to gold by weight, an ounce, a kilo, I don't know, but some fixed weight, not a dollar amount, but a weight. Now, the dollar gold market will continue as it is. But in that world, the dollar has to do all the dirty work. Because the dollar is going to be going down against gold. A brick unit is tied to gold by weight, and the dollar price is going up, meaning the dollar is going down. What's happening to the brick? It's getting more valuable. There would be a strong interest in having the gold. But here's why China's buying gold. And it goes back to what we said earlier about seizing and stealing the Russian assets. Because let's say you're a central banker, finance minister of any country that's running a trade surplus. You're making money. What do you do with the money? It's no different than you or I personally. We make money. We have to decide what to do. You pay your bills, but do I put it in a savings account? Do I buy stocks? Do I buy bonds, buy real estate, whatever? Countries have to do the same thing with their trade surpluses. So do you want to buy U.S. treasuries in a world where the U.S. is stealing them? Probably not. Do you like Japanese government bonds or German bunds or Italian government bonds any better? I don't think so, because if the U.S. is stealing them, why would those other countries be any better? So you very quickly get to gold. It may not be your first choice, but it may end up being your only choice once you get away from these government securities. We could be looking at stagflation. Now, the working model is if unemployment's low and growth is strong, then that's inflationary. If unemployment is high and growth is weak, then that's disinflationary or deflationary. It's like a seesaw, one's up, the other one's down. That's the standard model. There is no empirical evidence to support that model. The fact is there's no correlation between growth and unemployment on the one hand, so-called Phillips curve, and inflation on the other. You can have high inflation and high unemployment, which is what we had in the late 1970s. You can have low inflation and high unemployment, which we had in the 1930s. You can have low inflation and low unemployment, which we had in the 2010s. In other words, there's no correlation. While the Fed keeps saying we have to tighten to fight inflation, I'm saying there's no correlation between the two. They are tightening, but inflation will eventually come down on its own. But in the short run, it's going up for supply chain reasons, reduced oil output. Biden's draining the strategic petroleum reserves and the New England gas and diesel reserves, et cetera. I think we are looking at a situation right now, based on the data, where growth is slowing and inflation is going up. But the central banks that's not how they think about the world. And there's a name for that. It's called stagflation.